Good evening, everyone. My name is Vijeta Shastri. I'm from Type Bangalore. It's an absolutely delight to have a very seasoned and experienced panelist with Amrita Salyan, Sachin Jain, and of course, our wonderful partner and host, Humzat. So we'll keep it very simple, right? What is this all about? Of course, while every startup needs to raise funding, you want to make sure that your entity is growing, and obviously the vitamin C is critical. But equally important would be to understand the key legal and commercial concepts. And this is what this workshop, this discussion from our wonderful speakers is going to be all about. No more delays. Immediately over to the founder of Merger Domo, Mr. Homsad Charna, and to take it away. Thank you so much, sir.
Thank you, Vijeta. Hi, good evening, everybody, and welcome to another knowledge series from MSH, TIE Bangalore, and Merger Domo on key legal and commercial concepts for founders of startups. So let me introduce our panelists today. We have Amrita Salyan. She is a general corporate and transaction lawyer with over 15 years of work in venture capital, private equity investments, acquisitions, and commercial contracts. Welcome, Amrita.
Thanks for that.
Yeah. We also have Sachin Jain, who works as a principal associate in the economic laws practice, a tier 1 law firm in India. He's a part of the tax and regulatory team. We'll be taking a lot of help from him on the tax aspects, which are very critical. So what are the key takeaways today? So we thought, we'll keep it very simple, but we tried to cover a lot of critical aspects which you should know when you're going in for funding. So these include multiple angles which founders should keep in mind when we're looking for funding, such as valuation angles, ESOPs, what are the type of funding instruments, key governance and economic rights of founders, an interesting concept called flip structures these days, and a few closing and post-closing compliance under the Indian law. So let me start with valuation, which is a very critical component during fundraise. So Amrita, I'll start with you. And how does one determine the pre-money and post-money valuation?
Right. So there's no straightforward formula to determine. Post-money, I think, is very simple. It's basically the pre-money plus the investment amount will give you the post-money. That's how it's mathematically calculated. For pre-money, of course, I don't think there's a straightforward formula or a specific formula saying this is how you come to the conclusion that this is a pre-money valuation. It depends really on various factors, including things like the stage of the company, the promoter and the entrepreneur group, the promoter group and their credibility, their track record, etc. The numbers, of course. But from there are other factors as well. From a very legal sort of a point, I think one thing is if you have any liabilities on your balance sheet or anything, or things like tax liabilities, things like huge legal liabilities, those are accounted for while deciding the pre-money valuation, and those are discounted. So basically, it lowers your pre-money valuation in that sense. In addition, I think there are some other factors, things like warrants, or the kind of instruments that you basically come up with, which also affect your pre-money valuation. So yeah, that would be my response to this question.
Sure. So you mentioned about ESOP. So how does the size of an employee stock option affect the valuation of the company, Amrita?
Yeah, right. So it has a direct impact on the money.
Yeah, sorry. Yeah, Sachin?
No, let Amrita. Yeah.
Sure.
Yeah, so I think it has a direct effect on the pre-money valuation. What is important for founders to know is that valuation as a concept is basically going to determine how much of your company you're going to sell for what value, what is the price at which you're going to sell, and how much you're going to get diluted, right? So that's the whole concept of a pre-money valuation. Now, like I said, it can be negotiated on the various factors that probably are accounted for when one is agreeing to a pre-money valuation. But what people must remember is almost every term sheet, I think you'll find one clause on ESOPs. Basically, it'll be that you have to create. If you haven't already created, then you basically have to ensure that you create an ESOP pool of a certain size before the fundraise. Now, mostly this is always before the fundraise. I think it's useful for founders to check with their investor partners if they actually want this to be coming out of the pre-money. Now, if it comes before your fundraise, it basically means that you will first create the pool, right? And then you'll then get the investment in. So let's say somebody wants to invest 5 million in a company with the pre-money valuation of 20 million, okay? Let's say that there's already an existing ESOP pool of 10%, and the investor is asking you to increase it to another 10%. that automatically brings down the pre-money valuation from 20 to 18 mil. Because you're first going to raise it, you're going to dilute yourself, and then going to increase, and then going to get the investment into the company, right? So basically, it's affecting your per share value, because how do you arrive at the per share value? Basically, divide the pre-money valuation by the total outstanding shares in the company on a fully diluted basis. So you will account for this additional ESOP pool, and therefore it dilutes. That is one thing that I would recommend that most founders take a note of. It's usually there. There's usually a cap table that's appended to your term sheet itself, but it's useful for you to know so that there are no surprises later on. So you didn't assume that, oh, my valuation, pre-money valuation should have been 20 instead of 18. That's something that that's how it usually affects the pre-money valuation.
Okay. Sachin, you want to add something to it?
So here, one more thing that we need to, keep in mind is the accounting concept, of recording ESOP transactions. So every year, whatever is the difference between your intrinsic value and the market value of the shares which are going to get exercised, the difference is amortized for the entire vesting period till the exercise period. It is being taken into the P&L account. So it regularly hits your P&L account, and once, if they vest together, so they will hit your P&L account and will ultimately affect the valuation of the company.
Okay. And also, for the benefit of founders, what should they do if, the same thing they want to do it for subsequent rounds? So is it the same activity or something else needs to be done for subsequent rounds, Amrita? Or it's the same exercise that repeats?
It's the same thing. It really comes down to, I think the only point that people need to keep in mind as far as ESOP and valuation go is the size of the pool. And the best way forward is for founders to figure out how much do they actually need, because the purpose of ESOP is to really incentivize people. Very early on, startups will not, it becomes an attractive package to basically attract talent for people if you offer ESOPs. So I think one should decide and determine that the size should be determined based on the needs of the founders, rather than just going with a large pool, which will probably end up diluting your pre-money valuation in that sense.
Any average size? Because even when is it 5 to 10% of pre-money? How is it?
I think the range is 5 to 15. As the company sort of goes into an advanced stage, sometimes the ESOP pool starts reducing because there's so many other people on the cap table, and everybody takes a dilution generally. So there's a proportional dilution. But 10 is the most common. 10, anywhere between 5 to 10, I think, is what we see most commonly.
Sure. We will come back on ESOP as a separate point.
Sure.
Coming to, from a valuation perspective, what is the requirement under law on valuation reports? There's companies law, there's income tax act. Somebody says go to a merchant banker. Sometimes you have to go to the registered valuer. So for the benefit of the audience, it would be good if you could break this down.
Sure. So I think there are 3 requirements. One is under the Companies Act, one is under income tax, and the third will be under FEMA. That's basically your Indian Exchange Control Regulations, the RBI regulations. FEMA will only apply if there's a transaction between a non-resident and a resident. It does not apply to a transaction between a resident and a resident. Under Companies Act, the requirement is that you'll have to get a valuation certificate from a registered valuer who's registered with the Insolvency and Bankruptcy Council in that sense. That's one. Under Income Tax Act, it has to be from a merchant banker. So if you're having a transaction where it is merchant banker registered with SEBI, so if it is an R to R, that's resident to resident, you will need a merchant banker certificate, plus you need the one under Companies Act. If you also have a foreign investor where there's a transaction where it's resident to non-resident, you can go with merchant bankers, because FEMA usually says it's a CA certificate or merchant banker. So if you have residents, any transaction involving residents, you will have to, it's better to make it merchant banker. That's the key, even if there's a non-resident on the cap table. And get the one under the Companies Act from the Insolvency and Bankruptcy Board, the valuer registered with them.
I think one thing I remember is that when we were doing a fundraise last year, and we are registered under Startup India, and so there was there's an exemption for merchant banking if you're registered under Startup India. So could you throw any light on that? From a section 56 of it's an exempted for merchant bankers report, and it's okay to go for a CA or a registered values report?
Yeah, that exemption is there if you are registered with DPIIT. The
Yeah.
other thing is, if you are raising funds at the face value, even this merchant banker report is not required. You can just your calculation on your sheet and then you get the investment.
Okay.
There, the reports are also not required.
Okay, so I think the key takeaway for the audience, especially founders who are not aware, it will be good to register yourself under Startup India, get a DPIIT registration, and this is a very important waiver you can get for the merchant banker report. So moving on to ESOPs, Amrita and Sachin, who can be granted ESOPs under the Indian law?
So basically, you can grant it to any employee, consultant, anybody. But what you must remember, it can't be under Indian law granted to promoters or anybody from the promoter group or a director who has about 10% shareholding in the company. The exception to that is, again, if you obtain a DPIIT certificate, the startup certification from DPIIT, you can issue for the first 5 years of your incorporation, you can basically issue even to the founders. So that's another benefit of basically getting that certification.
And I would add to what Amrita is saying, what the companies are structuring as a structuring exercise, what they are doing is they offer stock appreciation rights to their founders, wherein, whatever appreciation or whatever incentives the employees get in the form of equity, to founders they issue in the form of the cash. The baseline, the base issues remains the same. They are granted options. They have an exercise period. They have a vesting period. The only thing is that instead of equity, they are being granted the bonuses. We call them bonuses. They are being granted the incentives in the form of cash. The difference between the fair market value and the exercise value. So that is the structuring that is being done by the companies to get the founders at par with the other employees also in terms of using ESOPs.
I think there's a relevant question to this. Somebody is asking the question is, how long is the DPIIT certificate valid? Is there any validity to it?
10 years.
10 years.
Yeah, it's basically
10 years, and as long as your turnover is less than 100 crore.
Yeah.
Okay.
That's the other condition.
Okay. Then when must one consider setting up an employee stock option pool? Because everybody is, especially for the young startups, there's always a confusion at the right time, at an angel stage, seed round, pre-series A, series A, or any other way of looking at it. What is the right time?
I think, in my view, it's better to start before your fundraise. The reason I'm saying that is because then you can decide the size of the pool, and you can probably have you can explain to the investor later, because invariably once an investor comes to cap table, you'll have to set it up. Everybody asks for it. So that's something that's going to happen. It's inevitable. Probably from a timeline perspective, also from freedom structure, rather than structure yourself independently. From that perspective, I think it's better to have one in place already, so that you don't waste a lot of time later at the time of fundraising and actually setting it up. And also it's beneficial because at some point, people, as soon as you set up the company, you would want to hire employees, etc., and you would be issuing ESOPs. A lot of startups do that to attract a lot of talent. And to be able to do that, you will have to set up something. So it's always good to set it up before even a fundraise starts, put the documentation, everything in place. You have a lot more flexibility then, less people to review it, less input. Time is also to give essence when you finally raise funds. So.
Yeah, that's true.
VCs would also want that, because as we explained in terms of accounting and everything, how they, the expense is recognized as of the difference between the exercise price and the fair market value. So VCs would also be looking at, whatever expense is being done is, charged to their P&L account before they come on board, so that once their investment comes in, and then there is no sort of a dilution, which is at par with what is already has happened before their company. So they would also want that.
When you talk about exercise price, won't it be towards the end of the ESOP? So at the 5th year, 4th year.
So sometimes what happens, so there are some acceleration clauses in your ESOP plan, wherein to few of the senior employees, whenever there is a fundraise, so typically when there is a VC funding, so the new investor coming in, so sometimes they take a call that all the ESOPs that are offered to the employees will be cancelled. So to few of the employees to retain them, the board takes a call to accelerate those ESOPs. So once those ESOPs accelerate, which means the vesting would expire beforehand. So let's take an example. There are 2 years of vesting. The vesting will expire within 1 year only before the VC is coming in. So that will hit their P&L then and there only.
Okay. Okay. Fair enough. For the benefit of the audience, I would like to give a real life example of ourselves also at Mojodomo, that when we went for our seed round, we went for our angel round. You know, there's a understanding that it's very difficult to handle VCs for ESOPs. But I think if you are at an angel stage or at a seed stage, the investors, which are retail or HNI investors, you know, they are pretty much forthcoming, and we also raised our ESOP after our you know, seed and angel round. So for all those who want to go ahead, it would be good that you must definitely go ahead, because it's a very important employee retention tool. Ultimately, that's the most important thing we must keep in mind. Structuring can definitely be done. Yeah. So moving on, Sachin, what is the possible structure which can be done to offer these benefits similar to ESOPs to founders or even late founders, so that as they cannot be offered, you know, ESOPs under law? Because
one is, as I mentioned, the stock appreciation rights is being widely followed, wherein, you know, since there is a restriction to issue shares to founders and directors, so they are usually offered to stock by way of stock appreciation rights, wherein whatever is the, you know, premium which is accruing to the company in terms of the valuation to the directors and founders, it is being discharged in cash. So suppose if I am an employee, I am having you know, an income of 70 rupees in terms of ESOPs between the market value and the exercise price, founder will be issued 70 rupees as a cash as a bonus itself in the same year.
What if the company doesn't have that cash? A lot of companies, though, you know, they're not
So
even.
it's an exercise period, no? So they can exercise it till the exercise period gets over. So they can have a clause of exercise period for, like, you know, 5 years, 10 years, or till they, you know, exit the company.
Okay.
So that exercise period can also be played around.
Okay. Okay. And any is there an overview on the accounting and taxation points for the benefits, you know, including, you know, Section 80 IA? What are the accounting aspects which should be looked after for ESOPs?
Correct. So let us dissect it into two. One is the normal startup which is registered with DPIIT, and then we'll discuss it with in case of startups which are ATISC company. So in the normal startups or any company, so whenever an employee is granted a stock option, so it has a vesting period, and then there is an exercise period and ultimate exercise. So whenever there is an exercise, so the fair market value of the company is being calculated, and what is your exercise price? So let's take an example. The fair market value of the company is 140, and your exercise price is 70. So what you are earning is actually a 70 rupees in terms of when you compare it with the fair market value. So that 70 rupees, when you exercise, that 70 rupees will be taxed as your salary, as perquisite. So one tax you pay when you exercise the options.
Right.
So this is the tax that will be paid. So here the company will have to do a TDS also. So since it is treated as a salary, your company will do a TDS and then will deposit it with the government. Many times employees have an issue that they don't have too much of cash, you know, because they have to give check to the company to buy those shares. So
Yes.
there the company plays around and they extend the exercise period to 10 years or till they exit the company.
Okay.
Second portion of the tax comes actually when they exit or when they sell the shares, and that is you know, called as capital gain. So there now the fair market value was 140. So you have already paid tax on 70 rupees. So now let's take an example when there is a next funding round and you are giving away those shares, or the company is going into an IPO or whatever it is when you are exiting. So let's take an example, it is being redeemed at the value of 200. So there this 60 rupees, 200 minus 140 will be taxed as capital gain. And then again, it will be long-term capital gains or short-term capital gains, depends on the time that you held. Now, very interestingly, government has, you know, come about with a very, you know, good dispensation for Section 80 ISC startups. So Section 80 ISC startups are those startups which are innovative and can, you know, develop more or generate employment in huge numbers. So in 2019, Amrita and I were discussing, I filed an RTI to know that how many startups have been recognized as 80 IAC companies. And surprisingly, there were only 126 startups. So these startups were recognized under 80 IAC. They enjoyed tax exemption for 7 years out of 10 years. Out of 10 years, they enjoyed income tax exemption for 7 years. For ESOPs also, there was special dispensation. So that when for employees, so whenever you exercise, so in my example of 140 minus 70, when I exercise those options, the tax was payable in the very same year. But if I am a Section 80 IAC company, government gives me 4 years to pay that tax.
Okay.
So even if I exercise that options today, I can pay tax after 4 years.
Okay. Sachin, one more thing. Is there any tax liability at the time of vesting also? Because
no,
no for the benefit of the audience, there is no tax at the time of vesting. And typically I've seen vesting is also done on maybe 24, 36, 48, 60th month, because it's a midterm retention tool. And while you vesting,
vesting is correct. So vesting is for accounting, as I said, for recognizing expense in the books of accounts of company.
Correct. Sure.
So it is very advisable if you're a tech company. The government is looking at tech companies very favorably, and if you give it a push and put in some effort, you can get recognized as 80 IAC company.
Sure.
And out of 10 years, it's a huge benefit to you if you enjoy exemption for 7 years.
Sure. So I think that was pretty insightful. Let's move on to the next key point, which is of what are the type of funding instruments. Now, as a early stage founder, it's difficult to know the jargon. So let us try to help the audience that what are the different type of instruments for fundraising. What is equity, preference shares, convertibles, safe notes. So Amrita, Sachin would like you to run us through these.
Yeah. So I think broadly, the type of instruments can be divided into two buckets. One is, of course, the equity bucket. The other is a debt bucket. Okay. And in instruments, whatever instruments is fall within either the equity bucket or the debt bucket in that sense. And there's another one, which is probably safe, which is in neither category in that sense. It's not very popular in India, but I'll come to that. So equity will be standard stuff, basically your equity shares, your CCPS, all of those will constitute straight equity instruments. CCPS is like a convertible equity instrument. It basically converts, but under certain circumstances. And then, after a certain period of time, nobody actually ends up doing it unless there's an IPO or something that's happening. Usually it's people exit with the CCPS itself. So that's equity, and CCPS is basically under equity. Convertible debt would include things like convertible notes, debentures, fully convertible debentures, right? All of those will come under debt. Convertible notes are also debt. This is something that everybody should know. That's why there's an interest rate account. That's an interest rate attached to it. And so it's akin to loan. It's akin to somebody giving you a loan unless it gets converted. And there's a trigger event based on which these instruments typically get converted into equity. Now coming to safe is basically something like, it's a hybrid version. It's basically like unpriced warrant. It basically gives you the right to acquire some sort of equity at a future given point in time, but there's no pricing attached to it right now. So it's unpriced. Warrants are usually priced. You usually predetermine, the price is predetermined, and then you say you have the right to acquire so many warrants or so many shares at so many at particular time, right? Safe is something that there's no price attached to it. There are questions that a lot of lawyers, I think there's a debate among a lot of lawyers on how can we make this legally compliant from an Indian law perspective. One, because convertible note and everything specifically are mentioned in exchange control regulations in FEMA, etc., which is specifically allowed. And for FEMA, one must keep in mind that what is not allowed means what is not specified is not allowed. You follow the strict rule with FEMA rather than trying to be innovative in it.
Still, I'm hearing that there is some popularity being gained. So is that at their own risk?
It depends. So I know of only one VC fund which has extensive material on SAFE. It's called the iSafe. I think they've said it, but I don't know, even under Companies Act, for example, why would this not be treated as a deposit? Maybe I haven't seen the documentation. Maybe they've structured it as a shorter period of time or something, because it'll get caught in the deposit regulations. Either it has to be debt, which is specifically allowed, and it's an exemption to the deposit rules, Or and also I think the other point to keep in mind is generally government regulations are not accounting for SAFE as of now, because it's not very popular in India, right? As and when same thing happened with convertible note, right? All the exemptions even under FEMA, under Companies Act started coming when people started doing this more often.
Sure.
Then the government will try and regulate it.
Sure.
So probably that's the journey we'll see with SAFE as well.
Sachin, anything from your side?
No, so I think Amrita has fairly covered that.
So just for the benefit of the audience, just to give a perspective that so we also used a convertible preference share route in my early days. So what I realized was that it is a very useful instrument when valuation is a challenge. You say 15 crores, 2 million, investor says 1 crore, because you have nothing to show on paper. So it's a good instrument which I would urge new startups to explore, because it's an opportunity to tell the investor that let's look at the business and not the valuation. And valuation is typically pegged at the a subsequent round. That's what we did. We pegged it towards a subsequent round with a steep discount of say 33%, 40% discount. So that is the upside which you give to the investor who's taking a bet early on you. So definitely it is a interesting route to explore, but yes, not all investors are in favor for it. So as Amrita said,
I just wanted to say one more point. Good that you brought up this point. Yeah, a convertible note is basically used at a time when there's no valuation exercise that's done. Yeah. But one thing I would advise all founders genuinely is, please, you as a founder should know what your dilution will be like once a convertible note converts, right? You have to have a fair idea. You have to make projections, because there's always going to be a cap and there's going to be a floor for the valuation. Yeah, so you have to calculate accordingly, go with the cap and see how much is the maximum dilution, because it can be very dilutive later on if you don't
absolutely. There is a fair chance that you miss the projections, you won't make it to that valuation, and the future valuation may drop. And on that, 40% further discount would be much more than that 40% on the bigger picture. So
absolutely, that's the issue. Yeah.
So, Amrita, what are the key factors one must consider for choosing this type of instrument? What is the timing that we discussed, the stage? What else could be there?
I think the investment size, the timing, because things like convertible notes are not very voluminous in terms of documentation. If you're comfortable and you have a clear idea on the dilution aspect, then that's something that can be done. Investment size is another thing, because usually investors who putting in large amounts of money will probably not agree to a convertible note. They'll be more happy taking on equity investment with rights that are predefined and documents that clearly tell out the amount of rights they're getting in the company. The other thing is also, I think, these are the only factors that one must consider while deciding what nature of instrument you want to. You basically want to get your investors to invest in the company. Largely, it's dependent on the investor preference, because investors have clear preferences on what they want to do and what they don't want to do.
I think there's a query that came that, so someone is asking, can't we enter into loan funding without knowing the percentage of convertible options? Loan funding without knowing it can't be a loan.
Yeah, the loan as in from just a loan, that's just repayable.
That would be a different structure. So Gaurav, is that the question?
Correct.
Into a loan funding without the percentage of convertible option? No, I don't think it can be.
They might be speaking about the unsecured loan from some investor.
But that's a very different ball game then. That's a very different ball game. Yeah. Anyway, okay. So, Sachin,
probably they're asking about venture debt, maybe.
Maybe, but it doesn't look like that. I think. Yeah. Repayable loan. Then see, repayable loans and all are very much based on cash flows. Then it's not about equity. It's cash flow game ho jata hai.
They would also want security against.
Yeah, if you can't pay, it will get converted into equity. That was a question.
Okay, if you can't pay, it gets converted into equity, not in these instruments. Amrita, is that there? I don't think it's there on such instruments.
Convertible notes are also drafted the same way, right? You draft it for the sake of drafting. Like there's a liquidation event, for example, before the note converts, you have to pay the entire principal plus the interest, and it ends there. The convertible note gets cancelled. Otherwise, when you do the next fundraise, it gets converted into at the equity or whatever instrument you are specified. It has to be equity. So equity instruments at the next round's valuation. So that's how it usually happens. But there's always a cap and a floor for the valuation, because I don't think it's possible to negotiate convertible. I mean, it's in everybody's interest of various parties, both the founder and the investor, because I mean, the floor is important for the investor and the cap, of course, will be important for the founder.
So Sachin, one important word, which is something which we would like the audience to understand, is angel tax. If you can, give an overview of that, it will be important today.
Yeah, so few years back, the government has troubled a lot of startups while they issued notices left, right, center, and then they freeze their accounts as well for recovering tax on this angel tax. So angel tax is something where a startup raises, and also let's understand it from an example. So if there is a mainstream corporate, if they are raising fund from some investor, they will have a valuation report, they will have book value and everything, and then based on that, some seasoned investor will come and invest. But that doesn't happen in startups. In startups, you invest based on the vision of the founder and everything. So your book value may be 10 rupees, but the investor is investing 100 rupees. So the government came back and said that, boss, see, if it is happening likewise, that 90 rupees differential which is there between the fair market value of the company and the value at which the investor is investing, you will pay tax on that 90 rupees. So it hounded the startups for a very long time, and in 2019 or 18, the government exempted startups registered with DPIIT.
Yes.
So if you are registered with DPIIT, you need not pay tax, angel tax. Otherwise, you will be made liable to pay angel tax. And I must tell you,
is it only startup registration, or there is a CBDT angle also to it? That you need a CBDT approval also?
So for DPIIT registered startups, you don't need it.
Okay.
So there is a straight away exemption. And I must tell you, if you are not registered with DPIIT and you come under the net, the government or the authorities will make your life miserable. They are going to straight away freeze your accounts.
Sure. So moving on to a certain, next point, which is of governance and economic rights, Amrita and Sachin. It's important that, to highlight to the audience what are the key governance rights that are negotiated or can be, provided to the general guidance to founders on how these rights can be negotiated.
Sure. So I think there are two key governance rights. One is, of course, the board observer seat. And the second is something that's called the affirmative voting rights or veto rights or AVM rights, basically. Boards basically to founders is to basically look at it commensurate to the percentage that the investor will finally hold in the company. So typically, most investors who anyway invest between 5 to 10%, it's commercially negotiated, ask for one board seat. The thing to remember is for founders, when you first raise funds, it's important that your first fundraise document set the tone for how you're going to structure these governance rights, right? For example, one good thing to do is to put a threshold for all of these board seats. So an investor may hold 10% today, but tomorrow if they don't invest in your company, they may dilute down below 10% to even 5%, right? At that point, you may not want people to hold board seats. So it's important to put a threshold in terms of a shareholding percentage, saying that whatever your board seat is linked to a certain threshold. This will also help you set the narrative straight for the next round investment, because then you would have said that everybody with a certain level of percentage is only entitled to board seats. That way, negotiations become easier and you don't get into very protracted negotiations unnecessarily.
Okay, but Amrita, if I play the devil's advocate from the investor's side, then that means I have to invest every time in the next time to retain my board seat.
But that's common, because if the kind of rights sometimes in very advanced stages, right? You don't want the board getting very cluttered. Let's say you raise funds at Series A, gave away a lot of rights, input thresholds, etc. You reach Series E, right? You're going to, if you start doing that with every investor, and let's say you have 6 investors on board, by the time you reach Series E, you're going to have 6 board members, 6 additional board members. It's going to become, and it's also going to become problematic for the anchor investor. Because everybody wants to, the anchor investor's job is to basically steer the company, take decisions, right? So they want a cleaner board structure. It's also important for the founder to keep it that way so that there's more flexibility. And it's not at all unfair. It's something, I mean, not suggesting something that's very unfair. It's a very fair position to take, because if you came in at an early valuation, you got 10% of the company. Tomorrow, you don't invest in the company. There are other people, for whatever reasons, there are various reasons why one would choose not to invest. Maybe there are others, more interesting investors coming on board, etc., and you want to take a backseat. Naturally, it's a natural progression that commensurate to the percentage that you hold in the company, that much rights you should get at any given point in time. Sure. So that's the thing with board seats. The second governance rights is basically through something that's called affirmative voting rights. Basically, these are a list of matters over which you have to take the investor's prior consent before sort of doing or before undertaking anything in that list. For example, it could be things like debt beyond a certain percentage. It could be the increase in Esop Pool. So anything that dilutes the investor, or affects the valuation adversely, or affects the financial position of the company will basically be in that list. Most investors ask for standard items in the list. Sometimes it's exorbitantly long, sometimes it's very short. One thing to remember is, again, always keep in mind from a founder perspective that it's important to structure these rights, link it to a shareholding percentage, because early on you will not have a problem, but later in advanced stages, you'll have too many consents that you need to take, and administratively it become a nightmare. And put in decent thresholds. For example, even if the investor wants to have a say in indebtedness, put in a threshold, put in a monetary threshold saying that is, commensurate to your business, knowing your business, the kind of debts you need, etc. So that above a certain amount, I'll definitely come in and ask consent, but below it, I need flexibility. So I think it just needs a little bit of thought, and everything. The thing to remember, that needs to be structured commensurate to the shareholding of the investor.
Does these tag along, drag along rights also come under this ambit?
No, those are more share transfer related rights. So basically, those are rights that basically affect the founders directly. For example, if the founder wants to transfer shares, obviously because the investor is investing in the company, and also the founder, betting on the founder to run the company and run the show, they basically don't want the founder to transfer shares. So there's going to be something that's called the right of first refusal.
They will, along with the first refusal, they're saying if he's selling it, the investor's lot should also be taken along. That's why
tag along.
Tag along.
Yeah. That's a tag along concept. Yes.
In many cases, the founders also negotiate on not only on the board seat, they also negotiate the management right itself, that they will only be the MD or CEO. As one of the funding that we advised, one of the startups, the founder had extracted these rights from the investor, that he will always be in the managing position, or is the CEO, or any position which is carved out. Okay. As we are also looking at the recent feud which is going on between Z and Invesco, the entire fight is happening around the position of the CEO.
This point, okay, but I've not seen it very as a common point being put by founders, but maybe from taking an example of this tussle, it might become a standard norm.
Actually, with most VCs, they would want the founder to be, because VCs are not, they don't do control deals, right? So they actually want the founders to,
So, coming from governance rights, if you can give inputs on the key economic rights, Amrita and.
Sure. So economic rights, to my mind, the key economic rights would be three, which you'll commonly see in a term sheet. Of course, there'll be many others in your documentation as you go along. But the three most important rights, one is the liquidation preference, second is the anti-dilution, and third is the exit right, because all three have financial implications in terms of the money that the founder has to pay under certain circumstances, or the company has to pay under certain circumstances. So I'll explain each of this and try to put in the market standard that people usually. So the first one is liquidation preference. In negotiating all these three rights, it's what is important fundamentally from a founder's perspective is to keep a very balanced position, because there are different ways of negotiating. This is where good advice will help you structure it in a manner where you set the tone right from your Series A or pre-Series A documentation itself. Let's take liquidation preference. Liquidation preference is basically its downside protection. Essentially it's downside protection. What it means is, if the investor has invested, say, 5 rupees in your company, I'm giving a very basic example so that we don't get confused with numbers. Tomorrow, if the company is winding down, or if there's a liquidity event where you have to sell the company or substantial portion of the company at 3 rupees, they want you to make sure that such a deal doesn't happen and that you return to them at least the 5 rupees that they invested in the company. That is called the 1x protection. So basically 1x is representative of the number, the investment amount, the entire investment amount that somebody has put in. Now, the second concept with liquidation preference is it can be either participatory or non-participatory. Okay, and participatory, it's completely commercially negotiated with founders. Most people go with non-participatory option, basically meaning that once your 1x is paid off, you don't get to participate in the rest of the pool when the equity players are getting their money. So you don't get to do that. If you agree to a participatory, then the investor will first get 1x and then dip into the rest of the pool as well. So here, it's even this 1x, sometimes people negotiate on that. It's a 1x is market standard generally. It's always important to, as advanced series happen, there's also a preference, there's a waterfall that comes in saying this Series A investor gets paid first, the Series B will get paid first, then the Series A guys, then the pre-Series A, then the founder, etc. So as more and more people get stacked, mathematically it starts becoming unviable even for investors. Advanced series, I'm saying. So people usually keep a very balanced position. What is important to remember is you set the tone in your first round of funding itself. You tell them that this is what I want to keep overall, and keep a very balanced position.
Amrita, practically, how will you do it? If the value is 3 rupees and if you are at 5, you are invested 5. Now, this is not like a debt instrument that you have some mortgage, you will sell it and recover the money. It's gone, no? So how do you actually, practically, how will it happen?
That's a very good question. So it's usually 1x or pro rata. So if the money is not enough, if the pot is not enough to distribute the money 1x, it usually goes pro rata according to your shareholding. So if you hold 5% in the company, you are entitled to 5% of that pot.
Yeah, that's fair enough. That's fair.
Yeah, this 1x is always goes with pro rata. It says higher of 1x or pro rata. That's how it's usually drafted. Okay, and the 1x component is what everybody negotiates on. Some people ask for, but I think market standard, everybody asks these days 1x. Very sophisticated investors are happy with 1x because it's not meant to be situation where where there's profits or where there's a good scenario. It's only meant to cover liquidity and liquidation events rather than anything else.
So that's the first part you were saying. That's the first economic right you mentioned.
Yeah. The second one is anti-dilution. Anti-dilution as a concept is basically used when an investor is invested in your company at a certain price, and you raise the next round at a price that's lower than the investor's price. So let's say an investor came in at 5, you do the next round at 3 rupees. Okay, but that's going to dilute the investor massively. So there's going to be a formula in your agreement to compensate the investor.
You came at par at the lower value, so you have to give him additional shares.
Yes.
For that at the lower valuation.
Correct. So the thing to remember is how do you achieve that? How do you compensate, right? That's the thing. So usually it's a formula. There's a broad-based formula, or there's a narrow rate, that kind of formula. What is important to remember is you agree to something that's more balanced, it's more favorable to the company and the investors in general, because the idea is to basically make this compensatory. So there are some formulas where it will just be an adjustment of the price, where the conversion price will get completely changed to the new round price, which is like a drastic thing for the founders, because the founder then will get diluted fully. So more balanced thing is broad-based weighted average. That's the standard formula, which accounts for a lot of things. It's a formula which basically accounts for the existing outstanding shares, plus it accounts for the new capital that's come in, new price, and then you arrive at a conversion price using the formula. That is something that's more balanced position to take. Most investors are very happy with that position, because it takes in investor concerns as well as the founder concerns.
Let me check that in my sense, because we have
you should.
But this formula, none of my lawyers, we didn't capture this. I think that's a good input from that side. That I was under the impression it goes to the lower side. If you are at 100 and now you're at 50, everyone has to be compensated at 50. But you're saying that's not the case.
That's not standard. It's a very aggressive position to take for an investor. Having said that, I've seen people ask for it, but it's up to the founder and the founders council to push back and basically put more. Sure. The minute you do that, I think everybody agrees, because everybody knows that the more balanced position is broad-based weighted average.
So that was the second point. So
that was the second point. Third point is on exit. You will see in a lot of investment agreements that there's an exit price. People will say, I want 1x or whatever. So under FEMA, it's important to remember now that under Indian exchange control regulations, you cannot have an assured exit price. Okay, so that's why a lot of people keep it to FMB. It's simply put as FMB. It's not, it's not linked to either a 1x or anything like that, because you can't really give an assured exit to anybody. But with residents, if there's basically a resident to resident sort of a transaction, sometimes these things do come up, and there it's good to actually. My suggestion always is to set the tone right in the first round itself. So be a little more explain to the investor that once more investors come on board, the newer investor and the promoter are going to be on one side, because the more rights you're going to give to the other person, that's going to affect the people who came in early. So I always say that the first funding round is usually it's a very tricky funding round, because later on the early investors and the founder become one team, right? Because all the other rights get stacked on top.
Do you see this happening at the Series A? When do you see this typically?
With most sophisticated investors, everybody is happy with the FMV these days. Nobody asks for an assured return because they're aware of the FEMA provision, and most of these are.
I used to see these in private equity deals where they would say that we want a 30% IRR. You load something on the P&L, and then there is some. If they don't get a 30% IRR, it will be a promoter assurance or a buyback from the promoter.
Put option.
Something like that. But I've not seen it in angel funding typically, or in
angel and even VCs. I think even private equity guys these days, maybe some of them do it, but with VC funding and all, it's very non.
Sure.
I mean, people will ask, but it's useful to know these things, that the law is actually on your side, and basically to structure it accordingly. And it's important, because if you start agreeing to what you set, if you give it the first guy who comes into your company some rights like this, you can't deny the second guy, right? Because the second guy will say, I'm actually giving you a higher valuation, putting in money at a higher valuation. Why are you then sort of undermining my rights? If you've given this already, either you have to go back and change the rights of the first investor, which is not going to be possible because you've signed, and these are all basically legally enforceable rights, right? So you just signed up. So it's better to actually set the tone right at the beginning. That's why I keep harping on that point again. It's very important.
Sure. So I think these are very important economic rights which you mentioned. In considering the time that we have, just one more thing. So I think there's one more point, and then we'll go into Q&A.
Yeah.
And this is what are called flip structures.
Yeah.
Now, this was made very popular. If the audience might know that Flipkart had done it. That you go and register a company in Singapore, and whatever the shareholding is in the Indian entity is mirrored in the Singapore entity or somewhere. So can you throw light on what exactly is a flip structure?
Sure. So flip structures are basically structures where there's a parent company sitting outside of India, and there are subsidiaries in India or other regions. Okay. Basically, the whole concept of a flip structure is you want to raise investments for the entire group in one entity. The valuation and all the key assets get consolidated at the parent level. Usually, people do it because they believe that they have better opportunities outside of India to basically get access to investors or valuations, etc. They set up a company outside India that becomes a parent. The key assets, your IP, your whatever key assets, etc., is controlled or owned by the entity outside. That's where the valuation is built, and the entire valuation of the group is finally consolidated at the parent level, and the investment comes at the parent level. So one thing to remember from a regulatory perspective is there's a lot of talk these days in the new regulations. There's a draft regulations that are already out in the public. Is the RBI regulation on how, so Indian promoter who is an Indian citizen or a resident in India can make an investment in an overseas company, but that overseas company then cannot have a step down subsidiary. That's the rule of the RBI right now. So a lot of these flip structures are getting stuck with this regulation, and now there are some changes that are proposed by the RBI. So the step down subsidiary, when you create a subsidiary in India, it attracts round tripping. So basically, it's money that's the Indian promoter is putting in an overseas company, and that money is again coming back to the India company because the India company is the operating entity, and most of the investment is at the US company level. So that's something that's called round tripping, and the RBI is particularly concerned about this. The different structures that people are doing, they're doing gifting, they're doing ESOPs, all that. But right now there's a draft regulation by the RBI saying that it looks like they still want to keep that round tripping rule, and they probably give you some relaxation, but they want prior RBI approval for step down subsidies.
When should one look at this? What is the right stage And also there is a concept of a poem, place of effective management. So for example, when we tried that, chalo, let's do a flip structure, let's go to Singapore, we'll raise money. But we soon realized if your 99.9% business is in India, then what is you're not going to get any benefit. The investor just by registering over there is not going to happen. So what is the essence of doing this? When should one do it?
I think it depends. Two things. One is the operations, how you want to structure your operations strategically, how it helps you. Second is sometimes it comes as a request from investors. Sometimes it also founder needs, right? A lot of people think that setting up a parent outside will probably give them tax benefits or help them sort of increase the investor pool. Like US, a lot of investments happen at the US level, etc. So sometimes the question on timing is it's better to have a fair idea of how you want to structure this very early on before you start receiving your investments. The reason I'm saying that is because once people have invested in your company, then mirroring that investment involves a lot of cost. You spend a lot of money doing that and also time. It doesn't happen over there. A lot of regulatory things that need to be considered and also tax. I'll leave it to Sachin to sort of walk people through the tax aspects. But yeah.
So the bigger issue which, sorry.
Yeah, go ahead.
The bigger issue comes around the poem regulations, which says that, the place of effective management. So once you say that you are taking a holding company outside India and then doing a share swap or gift. So what does the income tax ruling say? So there was a specific ruling from the income tax tribunal which said that, this kind of transaction should be curbed and income tax should be collected. So what does they say that, if the key management and commercial decisions are being undertaken in India or any country, even if the company is outside India, it will be deemed that that company is a resident of India.
Correct.
So whatever income, even if you take your parent company, whatever income, whatever service you are doing for your subsidiary company, that income will also be taxed in India.
So does that lead to double taxation then?
Of course, that will lead to it will not. Sometimes what does it happen that even if you pay tax in Singapore, let's say, and then that income is being taxed in India, so the government of India will ask that you have rightfully paid tax in Singapore, you get the certificate from Singapore government. And it is not too easy that you have rightfully paid and obtaining all these certificates. So they will tax the entire income into in India.
Okay.
So there are specific rules that government has come out with. They have, specifically there are 4 rules that they have defined that your passive income should not be more than 50%. Your employees in India should be less than 50%, and so on and so forth. There are rules, but it is very difficult to satisfy those rules because while investigating the specific cases that go down to the level of email exchanges that have been done between the board and everything.
So then, is it happening, Sachin? Is this something which one should, for the benefit of the audience, is it actually happening or is just in theory?
It can happen, but you have to structure it in such a way which shows that all the board meetings are happening there outside India. Okay. You have to sometimes show that some decision was given by the founder. So let's take an example. You are sitting in India and you have moved some kind of a business plan. So out of 3 business plans, the board sitting in Singapore has rejected 2 of them. To show that, even if the key managerial person is in India, he's not the one who is running the show.
So then clearly, I don't see it as for a very young startup. I think this looks for a mature startup.
Pretty much wherein you have lawyers and you have, tax consultants who can, work around everything.
But then slight dichotomy, because Amrita is saying that it is best done before investors come. But before investors coming at a bootstrap stage, you would not have the muscle to do all these things.
I think it's get the necessary advice. I think speak to consultants, but they want to take the decision of doing it right now or later. At least structure it in a manner which will not affect you later. So you can do it simultaneously when the fundraise happens. But it's important to have conversations and know about this.
Correct. So
because suddenly
what we have come across is tax authorities ask for board meeting minutes. They usually ask for the emails which must have been exchanged between the secretarial department. What has happened after the decisions were taken? Where is your Indian director sitting? What role he is into? They will see the entire email trails, and once they come, they will take the entire data from you.
I think somebody in the audience, Mr. Ramakrishna Swami, is asking, didn't Flipkart go to Singapore to avoid or evade regulatory rules for the retail e-commerce? So he was
the e-commerce rules have come just now. They were not. It was a pure, investment decision. So their investment decision.
Okay. Okay, so I think
Other thing that just allow me 30 seconds. So what the issue is, when you have a parent company outside, of course, the Vodafone issue, everyone is aware about. The parent has transferred the Hutchison Hutch transferred shares to Vodafone outside India, but the entire capital gain was taxed in India. So when you mirror your subsidiary as the main business, those issues may also arise, that you are evading taxes.
Sure. So I think for the paucity of time, we'll put a stop over here. So we'll take up some Q&As. I think there's a question that, does India have founder veto power, overriding power like in US, where example Zuckerberg and Travis could overrule the investor board?
Yeah, so I'll answer that question. That's a very interesting question. This is not an Indian law question. It's more a commercially agreed sort of a position. It's very difficult unless the founder is a minority. So let's say you're in a very advanced stage where 50% or more of your company is held by several investors. At that stage, it makes sense for the founder to actually ask for a limited amount of veto rights. I've seen it in documents, even in India, Indian promoters, and investors are usually okay with it. And the rationale that's given is if you are diluted to such an extent where you have concerns that, with your shareholding power or your board seats, you'll not be able to take major decisions.
Would differential voting rights also be, something over here, or that would be a different?
That's different. That's different because, yeah.
So, but
this is basically only veto rights. And the rationale for it is, look, there are a list of matters where you need to take my consent. The only question where that will come is if my shareholding is so minuscule in the company because I have raised so much investment, and I'm worried that I'll get overruled.
How did all our earlier unicorns like the Flipkarts of the world, did they use these things that time? Because they were all reduced to less than 5% when they ultimately sold it to Walmart.
Correct. I haven't personally worked on Flipkart, but I've worked on a number of unicorn matters where, not number, I think I'd say a limited number, where the founder is so diluted that they've asked for these founder vetoes, limited list of founder vetoes, and have got it. Most investors are okay with it because the rationale, like I said, is the founder's genuine concern that, look, I don't have the shareholding power to basically make key decisions. And at the end of the day, this is my company. So
you can give or block a special resolution or any resolution?
A veto is basically before even you pass the resolution, you need the person holding the veto to say yes.
Okay.
So
sure.
It's a limited list of matters. It can't be everything under the sun, but limited list. Yeah.
Another question is, can shareholding percentage and voting rights be different?
Can shareholding percentage and voting rights be different?
Yeah.
That would be, yeah, that's basically differential. I mean, usually it's commensurate to the, if you hold one share, you have one vote on that share. If you want,
will come.
Sorry?
That's where differential voting rights will come.
Yes. But it's not, it's generally not recommended. I mean, you should always have one vote per share. I mean, I don't know many people why they would ask for, it's going to be a mess if you give it to anybody in your company, right? Because if you give it to somebody, someone else will invariably ask it.
Sure.
And it's always structured that way. I mean, it's structured as one vote per share.
Sure. Then I'll just take a couple of more questions. Thomas is asking that how do early stage startup dilute at the first round of funding from an angel investor?
How do the early so every time when
I think it's maybe a percentage. How much should they do?
Okay, it really depends on how much money you're raising, because the percentage that the investor will hold in the company will dilute everybody on the cap table just before the investment.
Good.
Right. So it really depends on your needs. And I mean, if you have, because investment amount is usually dependent on the needs of the company, and the founder knows best, saying this is the amount I need to raise to basically fund XYZ expenses, right? So if you're raising that investment amount, invariably there's going to be a dilution.
And I think this is where what we discussed, these convertible instruments can help them.
Help or not, if you're not careful. I think that's one sort of a con as far as convertible notes are concerned. But my recommendation to the person who asked this question is to not dilute too much at the angel level, especially if you have plans to raise investments going forward at the VC level, because most VC investors would want a sizable chunk. They wouldn't want to be paying second fiddle to angels in that sense, right? So if you're given 15%, they'll probably ask you 20% of the company, and that is going to dilute you further. So it's better to keep in, and it's always a good idea to not dilute massively at the angel level, and then especially if you have ambitions of raising more funds going forward.
I'll take one final question. I think I'll direct this to Sachin. That how much income tax does an angel investor have to pay on exit? I think you had mentioned this, but if you can just.
So they, so once, if it is a DPIIT recognized startup, and after 3 years they're diluting, they're exempted from paying income tax.
No, I think he's asking from the investor perspective.
Yeah, from the investor perspective, I am saying. If you
Okay.
are an angel investor, if the investment is more than 3 years, and if it is in the company which was the turnover is not less than 25 crores, then there is an exemption which the government has given. But there is a long laundry list of requirements that you need to fulfill.
Okay. Fair enough. So I think we've reached our timing. So I'll thank everybody. I'll thank you, Amrita. Thank you, Sachin.
Thank you. Thanks, Hamza.
For us out. And I would once again thank all our partners and TIE Bangalore, MSH for getting us this lovely audience. So I think I'll keep the floor open for some time. And if there are any discussions, we can have any discussions. Thank you. Yeah, Vijeta, back to you.
Yeah, so I think Vijeta has a bad voice today, but what we'll do is
I have a bad voice, but today we now leave it open for the open networking.
Yes.
We have quite a few